Hello and welcome to Trading Hour. I'm Sonal Putra and joining me today is Vinny Motiwala. Vinny, good morning. It's been a day where we've seen the Nifty falling below that 200-day moving average. It's below the 23,400 mark as we speak. Banks the only saving grace today, but the earnings season is over now. We've come back after a 3-day long weekend. There was an expectation that maybe there could be some follow-on buying that we could see. But no, that's not the case. It's the Bank Nifty which is supporting the Nifty recovery, the slight recovery that we're seeing from the lows of the day right now. But yes, it's a day in the red all across. The metal index that's doing well today, lending some support, but IT is the big drag. It's down around 2.5%. We have Nifty Pharma again, which has come in for a bit of profit taking, and energy index. A lot happening in the broader markets as well, and that's what we'll discuss on the show.
Absolutely, a lot that is happening in the broader markets as well. And just the volatility index, let's pull up the India Wix. That is also up almost 6% as of now. So keep an eye on that. That volatility seems like it's continuing even in today's trade. We have some of these top Nifty losers that one should be highlighting. Like Sonal also mentioned, IT is the top drag coming in. So we have those names like TCS, Infosys that are down and out in trade. Wipro among the top drags coming in for the Nifty 50. Other than that, Heavyweight Reliance as well as Axis Bank among the losers for the Nifty 50. While some bit of a green that we're seeing coming in, HDFC Bank, Hindalco and Hero Moto, that's managing to hold on to some bit of a gain and on the positive side at this point of time in trade as well. But a lot of movers, individual movers that we are watching out for in trade today on the back of numbers, a lot of news flow that is happening as well. Honasa Consumer on top, let's look at that. That is locked in lower circuit. Fusion Micro, that's down and out in trade as well, down 5%. That also locked in lower circuit. So yes, that's all we'll be talking about in terms of markets. But, continuing with the markets, let's also bring on board Anish Damania, who's the MD and CEO at JM Financial Institutions and Securities, joining in with us right now. Anish, very good afternoon. Thank you so much for joining in with us on this show. And earnings is over. US elections is over. Now everything that we were watching out for is over. Markets volatile. The Trump card, that is seeming like something bit of a volatility that we're seeing right now. But is that expected to continue? What are we watching out for now?
Yeah, I think one of the key things was the earnings season, in my view, and also our view as a house. We had seen some earnings disappointments in the last quarter and followed up with more disappointments in this quarter. So I think the correction in the market is also part of the fact that earnings have disappointed. There are several reasons for that, but among those which could be prominent is slowdown in consumption. And that could be led by many factors, including lower government spending. I think there is a possibility that the government spending will kickstart once again as the elections get over, and we should start seeing some of that starting to kick into the economy. So from that aspect, probably we'll see a better second half than the first half, and part of the correction which had happened because of this also can get reversed from that point of view.
Okay. Anish, good morning. Good to have you on the channel after a long time. But now that we are talking about maybe some recovery in government spending that would come by in the second half, something that we saw in 2020 as well, right? After the elections were done. Which are some of the sectors which will be in focus? Because there has been a drawdown across segments this time. It's not been good, or I would say largely stable for any of them. So which sectors do you think could be in focus, somewhere that you see some comfort coming up?
I think we are having our conference, right in the middle of at the end of this earnings season, and almost we have about 175 companies with nearly 50% of them represented by the CEOs and MDs. And when I see this kind of a representation from the top level management in a particular conference or event, it tells me that they will have a story to tell. And I guess that story could be a lot more positive than what we have seen so far. So from that aspect, I would expect that things are looking to bottom out from where we see. Secondly, in terms of sectors, I've seen particularly the domestic manufacturing has done better. The EMS companies has done very well. The PSU banks have done very well as compared to what was expected out of them, and even steel mining and some of the asset management companies, pharmaceuticals and diagnostics have done better in this quarter versus what the expectations were. So I think these are the sectors which one needs to watch out for.
Okay, surely we'll keep an eye out on that. You mentioned about PSU Banks, but I want to talk about overall, Anish, in terms of PSUs, right? We've seen a rally coming in last year when you talk about some of these railway names, defense names. Do you think that story is still left to play out? And, we could see a bit move on that PSU side as well?
We don't cover railway stocks, so not fair for me to comment. But I think on the defense side, also we saw markets running ahead of expectations to a great extent. All the PSUs had performed exceedingly well. I guess earnings in some cases have kept pace. So wherever the earnings have kept pace, probably we'll start seeing recovery back in PSUs. So to that extent, defense is one name which comes across where Bharat Electronics definitely has done a lot better than what most people expected them to do. In case of PSU banks, I think if you see across the board, across all parameters, they have done very well. So within the PSUs, I think there is going to be some selection where one needs to put the money. So clearly, PSU banks and some of the defense stories do look good.
Okay. So the other story that played out, so we saw massive cuts in mid caps and small caps in the month of October, but the flows were great. They were at record highs for mid cap funds in the month of October. In fact, equity flows were at record high. Now that we do have FIIs going away, but the support coming in from DIs, how do you look at the small and the mid cap space, Anish? Do you think now we could start finding some comfort and what we saw in October could continue now as well?
In the small and the mid-cap space, actually, if you see the earnings season, they have probably disappointed the most. I think what had happened in particular was most of the companies had run ahead of expectations, and therefore, in order to justify probably the kind of movement which we saw in the stocks uh, post our budget, uh, uh, we could have seen some adjustments upwards for earnings, and that probably has not come about. And to an extent, there has been cut in most of the earnings which we have seen. We feel that most of the cuts are behind us. And if the spending comes back, I think we are going to see even the small and mid caps do a little better.
Okay, hoping to see them do better going forward. But just one last word in terms of, obviously, we've seen the recent fall coming in the markets. What are we watching out for in terms of, do you think FIIs will now start coming back? Do you think this is what they were waiting for to enter India at this right time when they're seeing a bit of a correction?
I think it's still undecided if you were to look at it. We are still not seeing flows to an extent ebbing. There is a small ebb, but the outflows were very large a month back. We are seeing some ebbing, but we still need to see some more time before we can tell what's really happening there. I think now that Trump has got elected, there are diverse views which are coming about. Some people say that if it is going to be more inward looking, then people exporting out from emerging markets into US could also face barriers, and that could impact sales for most of these companies. But we need to see how that pans out.
Okay, yes, there's a lot that we need to see, but we are in a wait and watch mode, and we'll get some updates coming in from your conference as well, Anish. So looking forward to that. Thank you so much for joining in today with your insights and the market outlook as well. We'll do one thing, we'll slip into a short break now, and as we do that, we'll take a look at the highlights of CNBC-TV18's grand 25-year celebrations at the Global Leadership Summit, from thought-provoking panels featuring industry stalwarts like Piyush Goyal and N.R. Narayana Murthy to inspiring discussions on shaping the future.
Welcome back. You're watching Trading Hour on CNBC-TV18. Markets not doing anything pretty, not standing pretty. 23,380 levels is what around the Nifty is trading at, almost near the day's lowest point. But putting focus on commodity space because metals, that's not losing its sheen. And Manisha is joining in with us to talk about what's happening there. Manisha?
Well, thank you so much for that, Vinti. For the last 7 weeks, the metals as a sector has continued to post losses. Now, on Friday, after China announced removing of tax rebates from December 2024, we did see a strong support come in for the metal prices. Aluminum, for one, gained up by 5%. Aluminum, in any case, has been outperforming because we are looking at bauxite shortage, and that has led to aluminum prices at an all-time highs as well. Not just aluminum, we saw zinc and copper prices gain up as well. So even as copper prices did post the worst week in last 1 month, it was off the kind of lows that we saw in the previous week there. Zinc, for one, has continued to be under pressure. I would say the same for nickel as well, which is trading at a 4-year lows, has seen a 10% decline in last 1 month. Steel is trading at a 2-month lows as well because China is producing more steel and the exports from China are the second highest on record. So even as China does seem to be making some steps in sense of ensuring that the demand is improved and you do see higher prices for many of these metals, we haven't seen a sustainable reaction in most of them. So even as aluminum prices did gain 5% on Friday, we haven't seen a follow-up buying coming in for the markets at this point in time. What the street will watch out for, of course, is the dollar index, which seems to be looking at a pause right now, but still holding around that 1-year highs. It is going to be about the U.S. Fed meeting in the month of December, where the chances of a rate cut now have declined from 80% to less than 60% as well. So continues to be a volatile market. China did give some support initially, but doesn't really seem to be sustainably doing that.
Okay, all right. So continues to be a volatile market. We'll keep coming back to you for more updates on anything that happens in the commodity space. Manisha, thank you so much for joining in. We'll slip into a break now. Management of DEE Development Engineers will join us next to discuss their Q2 numbers and the way forward. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Well, DEE Development posted a good set of earnings with its profits and margins expanding YOY, while order book too growing 48% sequentially. Mr. Sameer Agrawal, the CFO at the company, is joining us now to discuss the quarter gone by and the outlook going forward. Mr. Agrawal, good morning. Thank you so much for joining in. Well, it's been a good quarter when we talk about the order book improvement. But I wanted to talk about the gross margins because it has seen a substantial decline this time around. The cost of goods sold has gone higher. The power segment's EBIT has fallen 674 basis points on a YOY basis. Can you explain what happened here? Are the raw material prices higher right now? And what is the outlook in terms of gross and EBITDA margins going forward?
So very good morning. Thank you. So as far as the order book is concerned, rightly, we have grabbed a new order from Dow Chemical, which is of 340 odd crore rupees. So it has increased our order book from 800 crores to 1192 crores as at 30th September 2024. As far as gross margins and EBITDA margins are concerned, if you see, there is a growth from last year to this year of 192 basis point from September 2023 to 2024. Vis-a-vis gross margins are concerned, so we are basically working on projects, and it depends upon the nature of the status of the project at which we are executing our jobs. So gross margins, if you see on quarter, there may be a change, but broadly, if we see on year basis, that always remain constant, and that has been remain constant over a last 10 to 15 years. So it has been the tendency of the business. This has been remained constant over the period.
Right. So you expect it to remain constant for the whole year. So we could expect this 70% range around for gross margin, 65 to 70. And also in terms of EBITDA margins for FY25, what is it that we're watching out for? Last year it was 13% around the EBITDA margin. This time it's around 15% for Q2 I'm talking. Do you think for the full year this 15% range is sustainable in EBITDA margins?
As we have already told that we are ramping our new facility, which is at Anjar near Kutch, that will be rolled out with effect from 1st January. And we are transferring our oil and gas sector business from our present Pioneer unit at Palwal to that facility, which shall bring down our lot of logistics cost as well as some operational efficiencies. And at the same time, since the capacities have been increased, therefore there would be huge amount of saving in terms of allocation of fixed costs. So all these 3-4 factors will definitely increase our EBITDA margins from 15% to anywhere around 20% or more. And as far as gross margins are concerned, they will also improve a little bit, but they will remain constant. So there would be a good amount of increase in EBITDA margins going forward.
As 20% mark?
Yes.
By when would that happen?
So, ma'am, currently we are at transition phase. We have got delay of 6 months due to disruptions of rains to ramp up our Anjar facility. And from the next quarter, we shall be getting better and better. And once we will start getting the orders from power sector, that will give us a good amount of boost to enhance our EBITDA.
Okay. You know, this is about margins, and you think that will be around 20% levels in next 18 to 24 months. Is that a fair assumption?
Yes.
Okay. So your cash conversion cycle, it has, I would say it has seen or stretched a bit, 213 days in Q2 versus around 162 days that you saw in the previous quarter and 172 days that you saw in Q1. What has led to that, and where do you stand in terms of working capital cycle?
So as you know, ma'am, it is an inherent nature of our business since we are dealing in projects and we have a hedging philosophy of procuring the material the moment we get the orders. And since the order book has increased, therefore we have to procure the material at that point of time, and that is why our working capital cycle has gone a bit increased by number of days, and it will come down to the normal level the moment we will start our executing the jobs.
Okay, sure. Just a last word in terms of growth, right? I want to understand in terms of the mix. You had previously guided that exports and the domestic front would be a 50-50 mix that we would be seeing from the company. So far this year, exports was something that was driving the growth. So going forward, how are we seeing export growth, and what is the mix that you're watching out for, and a growth guidance for FY25 that you're looking at 8 to 10%?
So as far as the overall business principles and philosophy, we are having a good balance in terms of our domestic as well as export market. Currently, I can say that we have more export orders, but going forward, since we are expecting good amount of orders from power sector, and those all will flow from domestic sectors. So by and large, we shall be hang around 50-50% domestic as well as export market. As far as the gross margins are concerned or EBITDA margins are concerned, our business philosophy remains same. Therefore, there will not be any kind of impact going forward if there is any way increase or decrease in export or domestic ratios.
Okay. All right, take that point, Mr. Agrawal. Thank you so much for joining in with all those details. So that's the word coming in from DE Development Engineers. Strong order book. The stock, though, is lower by 2.5%, but they expect improvement in margins going forward as well. We'll slip into a short break. We'll tell you why Honasa Consumer is under pressure on the other side and talk about other stocks in focus as well. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. And let's shift focus to NASA Consumers, the parent company of Mama. That is under pressure today and is trading below its IPO opening price after reporting its Q2 numbers. Mangalam is joining with us to give us more details on why we're seeing a pressure coming in on Honasa Consumers today. Mangalam?
Well, a lower circuit and pending sell orders on Honasa Consumers. So literally no glow for Mama Earth. If you look at the stock price as well, below its IPO issue price of 324 rupees. Remember, around same time last year, the company had listed from its 52-week high. The stock is down 45%. Today itself is down 20%. Why exactly is the stock seeing such a sell-off? If you look at, the issue price, 324, today's low is close to 297. The reasons are a couple. One, there is underlying consumer sentiment weakness. The company has reported a revenue decline in that, posted an EBITDA loss and posted a net loss as well. What is it that they are attributing this weakness to? They're attributing this to, one, the disruption that they are seeing due to the distribution model change. They had accounted for 50 crore in sales loss, and that's become about 70 crores. Mama Earth itself, their mother brand, is growing slower than expectations. Remember, Mama Earth accounts for nearly 70% of their sales. So as a result of which, if you look at the reported numbers, revenue came in at 461 crores, EBITDA loss of 31 crores, and net loss of 18.5 crores versus a profit of 29 crores as well. The way forward is something that we'll look at. If you look at the gross margins as well, the ad spends as a percentage of sales, there were supposed to be margin levers, but ad spends as a percentage of sales have actually increased largely because sales haven't kept up. And secondly, gross margins too have remained stable itself. What is it that the reason the company attributes as a reason to, weakness in Mama Earth? Even as other brands are growing 30% and they are targeting double-digit EBITDA in FY26 for Dermaco, the first part is that there is a wave of ingredient-based products as against natural products. So that is something that these guys are speaking about. If you look at any of the beauty stores and beauty products, you'll have, niacinamide, hyaluronic acids, etc., as against just natural products that are, being sought after. The investment allocation models have not evolved for offline-based brands as well. So as a result of which, they are looking at that too. And the third most important reason that comes up for you, they need to refresh brand mix across product, price, and communication, basically reset that business. For the distribution-related issues as well, the management believes that offtake scale-up of new distributors could take up to 2 to 3 more quarters. So that's something we'll most definitely keep an eye out on. So 2 problems for Mama Earth. So their core business not doing extremely well, even as their current reach has increased. The offtake optimization would take about 2 to 3 quarters. At a time when Street was paying premium to Mama Earth despite lower margins, was on account of its growth outperformance. But for the next couple of quarters, that growth outperformance has been kept in abeyance, which keeps brokerages unhappy as well. Maybe a lot of them will review the calls afresh once either of the two distribution-related issues or Mama Earth-related issues show signs of improvement.
Okay, all right, we'll watch out for that. So that's Mama Earth logged in lower circuit. And I'm also watching out for city gas distribution companies. These stocks are under severe pressure today. MGL, IGL, Gujarat Gas. And the news is that the government has gone ahead and they've cut gas allocation to these city gas distribution companies by 20%. And this is the second cut that has come in 2 months in a row itself. Now, the allocation stands at around 40 to 45%, which was at around 70% in the month of October. APM gas allocation has been continuously reducing. Now, remember, it was around 154% in FY21, fell down to levels of 100% in FY22. FY24 was 83%, and now it's half of that at 40 to 45%. What does it mean? It means that gas sourcing to these companies, it will have to be a mix of market-linked gas. There's HPHT, there's spot LNG, there's gas from newer fields, which is priced at a premium. Currently, they get APM gas at $6.50 per MMBTU, but the other gas sourcing is at a higher price. And that is what would lead to higher raw material pricing for these city gas distribution companies. And now at least 50% of their sourcing would come from market-linked price. This is the fear. If their raw material sourcing is higher, they'll have to go ahead and increase prices. How much? Around 10% is what the calculation suggests would be the price hike. And that's quite steep, to be very honest. If they do not do it, that would mean a margin hit for these companies, and analysts believe that they might not be able to take the entire 10% because of the state elections that are coming by in Maharashtra. There's Delhi as well. On the back of this, Jefferies has gone ahead and they've cut EPS estimates. They bake in fact, no APM allocation in the calendar year 2025. That would mean all of it will be market linked. They have lowered their EPS estimates. They have downgraded Mahanagar Gas to an underperform. They have downgraded IGL to an underperform as well. JP Morgan has also downgraded both these stocks. They have cut target price as well for MGL to 1300 rupees, for IGL to 343 rupees a share. And CLSA says that if they do not take any price hikes, that would mean there's a cut in EBITDA of around 30 to 35%. Now that's a big cut, and that is what the street is fearing, the policy uncertainty, Vinny, and that's the reason we are seeing that big cut on the stock price as well.
Okay, absolutely. You know, surely we'll be keeping an eye out on all these names. But time for a short break. But after the break, we'll bring on board Vinti Saraf from Vinti Organics to talk to us about their Q2 performance. So don't go anywhere.
Welcome back. You're still tuned into Trading Hour. Vinti Organics is in focus. The company reported its Q2 numbers. Revenue surged 19% on a YOY basis. EBITDA grew nearly 28% and margins expanded as well. To know this and more, Vinti Saraf Mutreja, the Managing Director and Vinti Organics, is joining in now. Vinti, good morning. Thank you so much for joining in. Well, it's been a strong growth on a YOY basis. Can you explain which portfolio or which segment led to this growth? Was it export-led? What has been the pricing improvement and volume improvement as well?
Sure. Compared to last year, most of our products this year have seen a volume improvement. Last year was especially low when it comes to ATBS because of the destocking effect, which we saw sort of improving starting January 2024. Again, coming to our new products, the antioxidants as well as the butyl phenols, they have all picked up in volumes compared to last year. IBB, of course, is a mature product and that remains more or less stable. So most of the growth that you're referring to in terms of revenue is coming from volume, is volume-driven growth.
Right. Okay. So you're highlighting it's a volume-driven growth. You did highlight about ATBS as well. I want to just see that because ex-ATBS, when you're looking at it in terms of the portfolio growth, seems a bit muted, right, for some types. So what are we expecting there specifically in terms of the growth ex-ATBS?
Sure. Actually, that is not correct, your statement. The percentage share of revenue of ATBS is constantly coming down in our portfolio. I mean, it used to be 60%. Actually, even this quarter, it was 40%, which means that our newer products are gaining in volume. And like I mentioned earlier, it is the antioxidants as well as butyl phenols, which are seeing actually a 30 to 40% volume growth year on year.
Okay. No, actually, what my colleague also meant to ask that it's largely driven by ATBS so far, and that continues to be the case again. So what happens with the newer portfolio? But as you said, it has started picking up in this calendar year with butyl phenol and antioxidants doing well as well. While antioxidants is scaling up, you've been speaking about that, the pace is lower than what the market had been anticipating. They were expecting it to be the big growth driver. Are we seeing some pricing pressure here? What is the demand? What is the outlook on this particular portfolio?
You are right on the antioxidant front. Approvals are taking longer than expected since it is used as an additive. The major users of antioxidants take a very long time for approvals. We are also seeing a lot of pricing pressure from China in this particular segment, which wasn't the case 2 years back. And hence, the growth is not as much as we had expected. However, it is still there, and we are still bullish on this segment going forward in the future.
So how long before you think there could be an improvement in pricing and approvals would come by, which are taking some time?
Yes, absolutely. We are getting approvals in many of these with many of these polymer manufacturers, and it's a matter of time where we are fully approved by all of them. Especially given that a lot of them are based in India and they want to develop an Indian supplier, an Indian source. So also as far as pricing, I mean, we are trying for an anti-dumping duty against China for antioxidants. Now let's see how that shapes up.
Okay. Your VOPL product commissioning, be it MEHQ, be it Guaiacol, that has been pushed through FY26 now, right? Do we expect demand and pricing improvement for these products in coming years? And once it does come on stream, what kind of revenue contribution are you seeing from here?
Well, that entire product portfolio of Viral Organics, which is the subsidiary, the total revenue potential is 500 crores, which includes 5 products, MEHQ, Guaiacol, Anazole, tertiary amyl alcohol, as well as PTAP, of which the MEHQ and Guaiacol section has been commissioned a few months back, actually. There we are, in the product sampling phase as well as the plant testing and commissioning phase.
Okay. All right. You had given a guidance of around 20% CAGR in terms of revenues with EBITDA margins of 25%. Are you on track to achieve that? Or now that you're seeing volume improvement, you can actually see an upside risk to that?
No, I would still maintain, and even given our Q2 numbers, 20% growth in revenue with a 20% growth in EBITDA as well as net profit, which would amount to about 26% or 27% of EBITDA margin. And this is what I think we will achieve in FY25 as well as hopefully in FY26.
Just a last word, Vinti, in terms of the next phase of growth and investments and capex, where is that post-commissioning of ongoing projects? What are we looking at in terms of that, as well as new product launches? When are we expecting those by?
So even the ATBS new line is expected to come on stream in a few months. Along with that, the other products in Viral Organics will take another 6 months to get commissioned. We are also adding more products to the antioxidant portfolio. And we will be making further downstream products from the existing products that we are making. Some niche products used in personal care as well as fragrance industry.
So when you say ATBS in few months, is it Jan 2025, which was the earlier date?
Yeah, hopefully by February 2025 and then 1 month of commissioning. But the real revenues from that line would come in FY26.
Okay. All right. Take that point. Vinti, thank you so much for joining and giving us all those details. So that's the word coming in from Vinti Organics. The stock, though, lower by 2%. It is actually at the day's low. There's been a sharp fall from the highs of the day. The new line for ATBS that was expected in January is expected to come by February. So some clarity there is what the street needs. Time for a short break now. We'll get you more on the markets on the other side. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18, and let's move on. Indigo CEO Peter Elbris spoke to CNBC-TV18 at the Global Leadership Summit. Let's listen in to some excerpts of the conversation with Sridhan Ban.
We're going to double in size in the next couple of years. Today we have a little over 400 aircraft, and we have another 950 on order. So that's sort of the growth trajectory we're in. And maybe just to reflect on the pricing side, I think India, by a long margin, is the most competitive market in the world. The value-conscious consumer will be there, whatever market segment you're in. And I think at Indigo we serve all these different market segments. But that in itself, and I think that's an incredible asset for Indian companies, because if you can address the Indian market, the value-conscious, price-sensitive, cost-driven market, you should be able to compete international. I would line out the number of 200 million. Today we welcome 3 lakh customers a day, 100 million a year. By the end of this decade, in 5 years from now, we should be double the size what we have today, 200 million a year.
Okay, with that, it's a wrap on this edition of Trading Hour on CNBC-TV18. Thank you so much for tuning in. But don't go anywhere. Halftime report up next.